Progress.
Good evening, students. I hope you have revised what we have discussed in the last session. So, last session we were just quickly recapping. We were discussing about the uh, charging section, which is section 4 of the Income Tax Act, right? We discussed about what is the tax year. We discussed about what is total income, what is income, and what is the definition of person. We also discussed about the assessee, right? All of that we had a discussion in detail, right? So in today's class, what are we going to do? We are going to look at the essentially the rest of the portion of your basic concept, which is more or less going to comprise regarding the tax rates, right? Then tax rate of the individual, tax rate of the company, AOP, BOI, all of that, right? And the partnership firm. So the rest of the section which is there of today's class, we are going to focus on that. And then later part of the last part of this particular session, we are going to focus on the rest of the areas which are given in your module. So that's what we will be covering, right? So let us get quickly started with. So first of all, now that you have understood that the charge is on the total income, right? Total income of the person. And on the total income, what are you going to apply? On the total income, we are going to apply the tax rate. So what did we discuss? That the tax rate is given by the either the Central Act, which is either the Finance Act or the Income Tax Act, right? So we discussed about that already. So the charge of the income income tax is on the total income, but the income tax comes from either the Finance Act or it is specified under the Income Tax Act itself, isn't it? So we are going to start with that. Now, first of all, we are going to look at the tax rates in respect of the individual, right? We are going to look at the tax rate for the individual, HUF, AOP, BOI, artificial juridical person. So let us quickly write about it. Just give me a minute. Just connecting my writing pad here. So for the tax rates of the individual students, we have two regimes that are operating parallelly, right? What are the two regimes that are operating parallelly? The two regimes are, one is the default tax regime, right? The default tax regime is often characterized as the, higher slabs, lower tax rates, and no exemptions, right? No exemptions, no deductions, or, basically few exemptions, few deductions. So it is characterized by that you get the higher slabs, lower tax rate, but you will not claim many deductions and exemption. So that it is very easier for the government to, verify also basically your income tax return. So it is essentially based on the ideology that because if you claim deductions, exemptions, the government also will have to invest lot of time to do the verification that whether you have done it correctly or not, whether you are claiming fake deductions or exemptions or not, right? But if you're not claiming anything, we are going to extend you the higher tax rates and the lower tax rates and the higher slabs. So for the individual, HUF, AOP, BOI, and the artificial juridical person. Okay. Now, in respect of the individual, we understand what is individual. What is HUF, students? So, HUF stands for the Hindu undivided family, right? So, in terms of the HUF, it is a family unit, isn't it? So, HUF essentially is that, you have the family property that you are putting it for, undertaking maybe, any business or undertaking any investment activity that is operated under the Hindu law which is there, right? So the HUF concept which is there, it is coming out of that law. So that is a separate entity, right? HUF is treated as a person under 277, right? So it is not defined under the Income Tax Act. If you ask me, the HUF is not defined under the Income Tax Act. So HUF which is there is created by the Hindu Personal Law, Hindu Law or the Hindu Succession Act, right? And that is basically created upon the marriage of a Hindu. Okay, so it is basically, it allows the family to pool ancestral wealth. It can have its own separate PAN, own bank account. It can file independent tax returns, right? So HUF is a person. What about the AOP? What is the difference between the AOP and BOI? So AOP is formed out of an agreement. AOP is formed out of an agreement. Again, AOP and BOI are not defined under the Income Tax Act. You have to understand it in a common parlance. AOP means when persons come together, they form an association, they form a joint enterprise, right? They make an agreement that, okay, we want to, do this jointly. We will have a common objective to undertake this particular business, right? And maybe let's say on the completion of this objective, we will dissolve this AOP. So AOP is also a person. Under 277, AOP is recognized as person. When you come together to do some or achieve some common purpose or objective, to share the profits and losses, that is AOP. Now you may ask, ma'am, what is the difference between AOP and the partnership? See, partnership is constituted under the Indian Partnership Act. Right? So if it is not constituted as a partnership registered under the Partnership Act, under the Partnership Act, everybody, like the act of all the partners buying the other partners buying the partnership firm. Here it is not there. Here there are, people just coming together for some common purpose. Now, under the AOP, anybody can be there, any person. It is not necessarily that only individuals can form AOP. Even two companies can form AOP. But the companies cannot become like the partners. Like partners has to be individuals in a way. So even the partnership firm can create the AOP. So AOP, when it is created, it is an association of person. And then what is body of individuals? BOI only consists of individual. Again, AOP and BOI are more or less same, where people come together for a common purpose to earn the income collectively. But BOI is basically body of individuals. It can only have individuals. For example, some club is formed. Like, all the members come together for forming a club to do some sort of, like, let's say, have a gym. So it is functioning for the benefit of members only. They will get the membership charges from the members, and then they will give the services to the members only. Right? So that can be formed in the way of BOI. That is not a partnership. So AOP or BOI are basically the person. What is artificial juridical person? The entities which are not natural person. But again, they are separate entities in the eye of law. For example, any sort of universities, any sort of, like bar council. These are artificial juridical person. These are not companies. These are not partnership firms. These are entities. Right? So these will be considered as the artificial juridical person. So now for these, the tax rates are same. The tax rate for all of them are same. So one we have is the default tax regime, as I told you. Now, when we talk about the default tax regime, we mean that this will be considered as your default tax regime. By default, these tax rates will be applicable to you unless you exercise the option of opting out of that. So there is a default tax regime applicable to them under section 202. of the Income Tax Act. So they will have this default regime. Default if they do not opt out, if they do not exercise the option of opting out. Then in that particular case, there will be the tax as per the default tax regime. So we are going to look at the 202. But here I'm not going to go much in detail about 202 students. The reason is you will have that separately under the assessment of various entities chapter more in detail. But I'm going to definitely talk about the 202, and for that I'm going to take you to the Income Tax Act. So let us look at Income Tax Act 2025. I think I've opened here. Yes. (202). It says new tax regime for individual, HUF and others. So it says irrespective of anything contained in this act. Student, what did I tell you last lecture? What is the meaning of the irrespective of anything contained in this act? What do we understand by that phrase? This is a non-obstant clause. Irrespective of anything contained in this act is a non-obstant clause. Isn't it? It is a non-obstant clause. So, this non-obstant clause will override the other provisions of the act. So, irrespective of anything contained in this act means that this 202 will override all other sections of the Income Tax Act. But it says other than chapter 17B. Other than chapter 17B, meaning it is overriding every other section of the Income Tax Act, including your charging section, including every other section. But it is saying other than chapter 17B. Let us understand what is 17B. So if you go on to the chapters, here it will show what is 17B. Let us have a look at it. So, just give me a minute. So this is essentially saying that other than this particular chapter, right? So this particular chapter which is there, it will override other than this chapter 17B, but subject to the part A, B, E, and this part of this chapter. So what does this mean? That this particular section 202 is overriding everything else, right? But it is subjecting itself to this particular chapter, meaning it is not going to override this particular chapter, right? It is not going to override this particular chapter. So it is going to retain this particular chapter as is. It will not override only this chapter, but it will override rest of all the sections of the Income Tax Act. Okay, so in that very case, we have to understand that this is a non-obstant clause. This is a non-obstant clause. So non-obstant clause has the basically overriding provision. Now, why is it subjecting to this particular chapter? So the reason for subjecting this to this particular chapter is that if there are any specific tax rates given, for certain income, those tax rates will continue to apply to that income. Okay, so essentially what it means is that, let's say for example, long-term capital gain, short-term capital gain are taxable at the specified rate. Then 202 will not say that long-term and short-term will also be taxed at the slab rates. Are we getting this particular point? So this is essentially doing what? That it is saying that, okay, I will override the entire Income Tax Act and say that the default regime will be this. However, I am not overriding this chapter which is there, which is talking about the tax rates. That chapter I will not override, because in that chapter there are some special rates which are given. And since those special rates will continue to apply to those particular set of income, I will not come and say that every kind of income should be taxed at the slab rate. That is what is the idea of saying subject to. Are we getting this particular point? So essentially when I say subject to means I am putting that as subsidiary thing, this particular section. Are we getting this? So here I think there is some sort of mistake in terms of writing this chapter number, because this chapter number doesn't exist. If you see, I was looking at that only. So it is chapter 13 and there is no chapter like 17B existing. There is no chapter 17B. If you see, there is chapter 17, but there is nothing called as chapter 17B in the Income Tax Act. So this particular chapter, what they are talking about is the 13, which is the determination of tax in special cases. So this 202 should have mentioned the term chapter 13 and not 17B. But what it is saying that irrespective of anything contained in this act, meaning whatever is written in the act, we are going to override, but we are going to subject it to this chapter 13 other than the chapter 13, but subject to part A, B, E and this part of this chapter. So basically wherever the special rates are given, for example, you have the specific rates for the long-term capital gain, right? You have the specific rate for winning from lotteries. You have the specific rate for virtual digital asset. right? Those are taxed at 10%, 12.5%, right? So those rates will be applicable and not the slab rate on those set of income. Are we getting this particular point of this first part which is there? I hope you are understanding. Okay. So what they are essentially trying to say that if you have some specific income which is taxed at a specific rate, then that rate, that specific rate itself will be applicable. Then we are not going to subject it to the general slab rates. That is what is the meaning of this particular part. Are we clear? So let us just write this down over here in the notes. Yeah. So there will be default tax rates and there will be specific tax rate. For example, LTCG, STCG, winnings from lottery. So that will be continued to be taxed at the rates mentioned in those sections. Now, what are the default tax rates which are given? So let us go back to 202. The 202 says, irrespective of anything contained in this act other than this chapter, the income tax payable by a person being individual, HUF, AOP, other than a cooperative society, meaning cooperative society will not be able to get 202, BOI, whether incorporated or not, or AJP. In respect of the total income for a tax year, see, the tax is on the total income. We have understood what is total income. We have understood what is tax here. Shall, unless the person exercises the option in the manner provided under subsection 4, be computed at the rate of tax given in the following table. So these are the tax rates that are given to me. Are we getting this particular point? What are the tax rate? Up to 4 lakh, it is nil. 4 lakh to 8 lakh, it is 5%. 8 lakh to 12 lakh, it is 10%. 12 to 16, it is 15%. 16 to 20, it is 20%. 20 to 24, it is 25%. And above 24, it is 30%. So after every 4 lakh, there is a slab change. And the tax rate increases by the 55%. Are we clear? So let us write down these slab rates. So up to rupees 4 lakh, nil. 4 lakh to 8 lakh, 5%. 8 lakh to 12 lakh, 10%. 12 lakh to 16 lakh, 15%. 16 lakh to 20 lakh, 20%. 20 lakh to 24 lakh, 25%. And 24 lakh to, about 24 lakh, 30%. So this is my tax rate. Right? So these are the slabs which are given to me. Now, as I said, this is subject to that you will not claim certain exemptions or deductions, which is what I'm not going to talk about at this particular stage. because you will learn that in the assessment of various entities, what deductions are not allowed over here. I'm going to restrict here because this is a class on the basic concepts. I'm just going to introduce you what are the tax rates. Now, if you see, it says that unless the assessee exercises the option of going out from this regime, right? We read that. So if the assessee wants to forgo certain exemptions and deductions, he can go for this regime. Alternatively, he can exercise the option to shift out of the default tax regime and pay the tax as per the old tax regime or the optional tax regime. Okay? So basically, my default tax regime will be 202, but if I want to opt out, I can claim the old tax regime. Now, this old tax regime is not given under the Income Tax Act. This is notified through the Finance Act. And if you recollect, in the last lecture, I told you. What did I tell you? In the Finance Act, where do you find it? Schedule 1, Part 1B. There you will find these tax regime. Now, the old tax regime which are there are dependent on the age of the person also. So, if the normal is up to rupees 2.5 lakh, it is nil. 2.5 lakh to 5 lakh, it is 5%. Then 5 lakh to 10 lakh, it is 20%. And above 10 lakh, this is 30%. However, if the individual is a senior citizen and a resident of India, if there is a resident individual, see, this is only for a resident individual. If a non-resident individual is over 60 years, this slab will not be applicable. So it is only for resident individual above 60 years but less than 80 years. So what is the slab? Up to rupees 3 lakh, it will be nil. 3 lakh to 5 lakh, it will be 5%. 5 lakh to 10 lakh, it will be 20%. Above 10 lakh, it shall be 30%. Alright? And for resident individual, above 80 years. So again, here it should be only resident individual. Otherwise, if it's a non-resident individual above 80 years, he will go under the regular slab of 2.5 lakh only. So what is the slab? Up to rupees 5 lakh. Nil. 5 lakh to 10 lakh, directly 20%. And above 10 lakh, it will be 30%. Now, in terms of the senior citizen, when do you see the 60 years or 80 years limit? Alright? So, an individual who is resident in India, more than 60, more than 80, but when do you see that? So, the CBDT in the old Act had issued a circular. Circular number 28 of 2016. Okay. So circular number 28 of 2016 provided that a person born on 1st of April, right? Now whether he will be able to get this higher slab, because on the 1st of April you are entering into a new tax year. So whether if a person who is becoming 60 on 1st April 27, will he get the slab rate of 3 lakh or 5 lakh in the tax year 26-27, or will he get it from tax year 27-28? So the CBDT has clarified that a person born on the 1st April would be considered to have attained a particular age on the 31st of March, the day preceding the anniversary of his birthday. So you don't become 60 years on 1st April if your birthday is there on 60th on 1st of April. You become 60 years one day before that. And therefore, for the tax year 26-27, you will be able to get the higher basic exemption limit of 3 lakh or 5 lakh. Are we clear? So, this circular is clarifying whose falls on 1st April shall be, or we can write here 20 and 27, eligible for higher tax slab in the tax year 26-27 itself. Okay. Now, this circular was issued in the 1961 Act, but will it apply to 2025 Act? Yes. That day only we saw or read about the transitional provision 536. That if any kind of circulars are issued over there, that will also apply to the incomes over here, to the like clarifications over here as well, right? Because the Act has not changed drastically. So that will continue to apply over here. Are we clear? Okay. So let us do some particular question on this particular tax rate. But before that, okay, let us do the surcharge and then we take up the question together. Okay. Now, this tax rate will be added with the surcharge. This tax rate will be also added with the surcharge. There is also surcharge applicable. So, you are going to add the surcharge over it. Now, what are the surcharges? So, in terms of surcharge also, there are the slabs which are given. There are the slabs which are given. Now, if you talk about the default tax regime, what is the surcharge? So, if the total income which is there, if it is including the dividend, LTCG, STCG, right? So, if my total income includes the STCG, LTCG, STCG covered under 196, and LTCG covered under 197 or 198. Okay, so both LTCG. So in this particular case, if this income exceeds 50 lakh but is less than rupees 1 CR, my rate of surcharge is going to be 10%. Okay. If my total income including dividend, LTCG, STCG, is greater than 1 CR but less than equal to 2 CR, then my surcharge will be 15%. If my total income excluding dividend, LTCG, STCG is greater than 2 CR but less than, but is greater than 2 CR, then in that particular case, my surcharge will be 25%. So therefore, what it means is that the maximum surcharge on the dividend, LTCG, STCG is 15% even if it exceeds rupees 2 crore. So let us understand with the help of an example. So let us say, for example, my total income consists of, let's say, dividend, which is, let's say, rupees 15 lakh, STCG, under 196 on listed equity shares and equity oriented mutual fund, 15 lakh. Let's say LTCG is 45 lakh. And I have other income, which is 25 lakh. So here, how much is my total income? How much is the total income? Yes. 50, 30 is 80 lakh, 80 lakh and 80 lakh and 95 lakh. Isn't it? So I have 15 lakh of dividend. So if I do the calculation over here, $15 lakh of dividend, then 15 lakh of the STCG, then I have 25 lakh, 45 lakh of the LTCG, and then I have other income of the 25 lakh. So it becomes 1 CR. Okay, it becomes 1 CR. So my total income is 1 CR, which is more than 50 lakh and less than 1 CR, less than equal to 1 CR. So here my surcharge is going to be 10%. Yes. Very simple. Let us say, next example is, let's say my dividend is rupees 15 lakh. Let's say my STCG under 196 is 35 lakh. Let's say my LTCG is, let's say 85 lakh. And I have other income of 55 lakh. I have a total income of 1.85 crore, which is less than 2 crores. So what will be my surcharge? 15%. Okay, then my surcharge is 15%. Let us take one more example. Let us say my dividend is 51 lakh. let's say my short-term capital gain under 196, 44 lakh. Let us say my LTCG is 97 lakh. So what will be my total income? Yes. And let's say my other income also, like I forgot to take other income, is 6 crores. So here, how will I calculate surcharge? Here, the surcharge will be 15% on the dividend, STCG and LTCG. It will be 15%. Right? Because if you look at it, 51 plus 44 plus 97, it is 192. Right? So that is more than 1 crore. So in that particular case, I will get the surcharge of 15%. But on the other income, that is exceeding 2 crores. So in that particular case, there will be surcharge of 25% on the other income of 6 crores. So are you following that? So if the total income excluding dividend is more than 2 crores, then in that particular case, the surcharge will be 25% on only that other income. If my total income including dividend is less than 2 crores, then surcharge will be 15%. Are we getting this point? Let us take another example. Let us say I have dividend of 40 lakh, STCG under 196, 35 lakh, LTCG I have, let's say, 92 lakhs. And other income of 1.1 crore. So in that particular case, my surcharge would be how much? So if you see, my income is 2.77 crore. My income is 2.77 crore. But my income excluding the dividend, LTCG and STCG is only 1.1 crore. My total income is 2 crore. But excluding the dividend, LTCG, STCG is less than 2 crore. And on dividend, STCG and LTCG, any which ways, the maximum surcharge is 15%. Right? So in that particular case, I will have surcharge of 15% on the total income of rupees 2.77 crore. I hope you are able to understand and appreciate this point. Okay? So, on the total income, you will first calculate the tax and then you will decide the surcharges rate. Now, understand one thing very, very carefully, that this particular surcharge rate is applicable again for individual, HUF, AOP, BOI. But excluding the AOP, which has only companies as members. If the AOP has companies as member, then in that particular case, this surcharge will not be applied. So, this is applicable to individual, HUF, AOP, other than having only companies as members. and BOI. So see students, if the AOP has only company as member, like there are no individuals, no partnership, then the surcharge rate will be not applicable to the AOP. Then there are different surcharge rate for that kind of AOP. But if AOP has one or two individuals, one partnership firm, one company as member, then this surcharge rate will be applicable to that AOP. Okay. Now coming to the old tax regime or the optional tax regime. What are the surcharge rate? It is very much similar only. It is very much similar. It is not something which is different. However, there is just one exception over that. What is that exception? That in the case of, this is entirely same up till year. So, up till year, this is same. There is just one addition over here. What is the addition? Where the total income, excluding the dividend, LTCG, STCG under 196 is greater than 5 crore. So, it is, this earlier slab is total income excluding dividend, LTCG, STCG under 196 greater than rupees 2 crore but less than equal to 5 crore. The surcharge is 25%, which is same. But if it is exceeding 5 crore, there is an additional surcharge of 37%. This is not there in the case of the default tax regime. So in the old tax regime, there is an additional surcharge of 37% over the income of the 5 crore. But the maximum surcharge on the dividend, LTCG, STCG under 196 is 15% only, even if the income exceeds 5 crore. Are we getting this particular point? So let us take an example for this. Let us say I have a dividend of 60 lakhs. Let us say I have STCG under 196 of 50 lakhs. Let us say I have LTCG of 67 lakh. And let us say I have other income of 6 crore. So if you see what will happen in this particular case, the surcharge will be 15% on my dividend, STCG and LTCG. Sorry. And on other income, there will be surcharge of 37%. Are we clear? Let us take one more example for this. Let us say I have dividend of 55 lakh. I have STCG of 60 lakh. I have LTCG of, let's say, 77 lakhs. And I have other income of 1.1 crore. So here my total income is 3 crores. But total income excluding the dividend, STCG, LTCG is 1 crore. So on dividend, STCG, LTCG, I can charge maximum surcharge of 15% only. So here there will be only surcharge at the rate of 15% on the total income of rupees 3.02 crores. I hope it is clear to everybody. Okay? Right? I hope this is very, very clear to everyone. Now, coming to the one more important aspect over here. There is something called as the concept of the marginal relief. So what happens is that, let's say for example, that there is an increase in the amount of tax due to my income marginally increasing. Let's say I have the surcharge basically, let's say starts from the 50 lakh rupees, right? It goes up to 1 CR. Then it goes from 1 CR to 2 CR. So let us say, for example, if my income is marginally higher by this amount. Let us say my income is marginally higher by this amount. So let us say the surcharge is, as I said, starting from the 50 lakh rupees. Right? And let's just say I have income of 51 lakh. By 1 lakh rupees additional, I will start having the surcharge. Or let us say after 50 lakh to 1 crore, I have income of 1 crore 10 lakh. So I will go into the next bracket of surcharge directly 15% because just I have income of 1 crore 10 lakh. So just by 10 lakh rupees, I have the additional surcharge being applicable. So there is something called as the marginal relief concept which has been introduced. What it says is, what does marginal relief provide? That ensures that since because you are having an increase in the total income marginally, and because of that you are liable to pay an additional tax because of your marginal increase in the total income. So then we will give you some sort of relief. So what is that relief? So that is calculated for each slab of the surcharge based on this formula. Earlier this formula was not given. Now as I told you, in the new Income Tax Act, they have introduced everything in the formalic manner so as to make it very easy for you. Wn is equal to un plus vn. Now what is this? Wn is equal to the total amount beyond which the total amount payable as income tax and surcharge thereon shall not exceed. So this is total amount beyond which the total amount payable as income tax and surcharge shall not exceed. Okay. Then UN is basically the total amount payable as income tax on basically rupees 50 lakh, because after 50 lakh there is surcharge, or rupees 1 crore because after that the slab again changes, or rupees 2 crore because after which also your slab changes. And if we talk about in the old tax regime, it will also include 5 crores. This is for old tax regime. And VN is my total income minus 50 lakh or 1 crore or 2 crore or rupees 5 crore. Are we clear? And here the total income that we are referring to, right? The total income that we are referring to, for the purposes of the marginal relief, it will not include the dividend, LTCG and STCG. Right? In case the total income includes the dividend, LTCG, STCG under 196, then the surcharge on the income tax computed on such dividend and capital gains cannot exceed 15%. Right? So that you have to keep it in mind. It can include, but if it is including, you have to keep it in mind, it cannot exceed 15%. So you have to compute the marginal relief accordingly. Okay. Now, let us take an example for this to understand how do you compute the marginal income. Let us say there is a total income of rupees 51 lakh. Right? Now, let us say, for example, we go for the assessee has exercised the option of opting out of Section 202 regime. So we are going as per the old regime, right? So first of all, we'll compute the tax on the total income. What is the tax on total income? Up to rupees 2.5 lakh nil, right? 2.5 to 5, it will be at the rate of 5%, which is going to come as 12,500. Then 5 lakh to 10 lakh, this will be 20%, which comes to 1 lakh. And greater than 10 lakh, it will be 30%. So it will come to 12 lakh 30,000. So my tax is coming to 13 lakh 42,500. This, since the income has exceeded 50 lakh, there will be surcharge, right? So it will be 10%. It will be 134250. So my total tax comes to 14 lakh 76,750 rupees. So now, since my income has marginally increased by 50 lakh, what I will do is I will apply the formula. So WN will be, WN is nothing but my marginal relief, right? So this is nothing but my marginal relief. So WN is equal to UN plus VN. Now what is UN here? Income tax. What was UN? Total amount payable as income tax on 50 lakh, 1 crore, 2 crore or 5 crore. Right? So income tax on rupees 50 lakh, because here it is 50 lakh in our case. So what is the total income tax payable on 50 lakh? 12,500 plus 1 lakh plus 12 lakh beyond 10 lakh, which is coming to 13 lakh 12,500. So if my income was 50 lakh, I would have paid the tax of 13 lakh 12,500. Now how much my income is increasing? That is my VN, which is basically total income minus 50 lakh. 1 lakh. So this comes to 14 lakh UN plus VN comes to 14 lakh 12,500. Right? So what is the relief that I will get over here is, so what is the tax that I am paying? The actual tax that I am paying because my income is marginally increasing by 15 lakhs or 1 lakh, sorry, is 14 lakh 76,750. But because of the marginal increase, I should have first of all paid 13 lakh 12,500 if my income would have not increased 50 lakh. How much is the difference between 50 lakh and the total income? 1 lakh. So that is what should be the maximum tax that should be payable by me. So lower of A or B will be my final tax liability. So my tax liability will be lower of A or B, which is equal to 14, 12, 500. On this, I will add a cess of 4%, which is 56,500. So 14 lakh 69,000 is my final tax liability. So what is the marginal relief? Marginal relief is A minus B, which is 64,250. This is the relief that I have got. Are we clear, students? Okay. So this is how we calculate the marginal relief. Fine. So this is how you can do for any particular question. Are we getting this particular point? For any question, you will have to do it in this manner itself. Okay. So that is the first part for your individual taxation. Now, there is also something called as the rebate. You get the rebate for the income tax, which is given under section 156. Okay, this is given under 156. Now, in order to provide the small taxpayers the relief, so that they are not burdened with the lot of tax liability, the rebate is granted under section 156. Now this rebate which is granted is only given to the individuals who are resident in India. The rebate is given only to the resident individual. It is not given to the non-resident. It is not available to the HUF's AOP. So this is only different. We are going to see both of it. Okay. So first of all, for the default tax regime, which is under 202, what is the rebate given? So in case of the default tax regime which is there. So let us look at section 156 itself. An assessee being an individual resident in India shall be entitled to a deduction of 100% of income tax payable or 12,500, whichever is less, from the income tax chargeable on the total income for any tax year if the total income does not exceed 5 lakh. Now this we'll see later. This is for the old tax regime. Section 2. Where the total income of a resident individual assessee for any tax year is chargeable to tax under 2021. This is your default tax regime. Then from income tax computed before allowing the deduction under this section, following deductions shall be allowed if. The first is if the income does not exceed 12 lakh rupees. If your total income here means the total income only. The total income does not exceed rupees 12 lakh, then 100% of the income tax or rupees 60,000, whichever is less. Are we clear? And if the total income exceeds 12 lakh rupees and the income tax payable on such total income exceeds the amount by which the total income is in the excess of 12 lakh rupees, right? An amount equal to the amount by which the income tax payable on such total income is in excess of the amount by which the total income exceeds 12 lakh rupees. Now this sounds very confusing. First wala to samajh gaya, right? But this second part, ma'am, it is very confusing. Let us break it down. So in the default tax regime, we have two parts. First, if my total income is less than 12 lakh rupees. This is very simple, ma'am. We understood. What is it trying to say? That my rebate will be lower of income tax or rupees 60,000. Very simple, right? So let us say, for example, if there is a resident individual who has a total income of 10.50 lakh, right? Now, if I have to say this is 10.50 lakh, what will be my tax on this? What will be the tax on this? Let us say, for example, this is going as per the default tax regime. So I am going under 202 only. So if you take the slab over here, alright? So here directly it is 10%. Up to 4 lakh nil, 4 to 8 lakh, it is 5%. Right? So what will be my tax liability? Yes. What is the tax liability that I will be getting here? 45,000 rupees. Isn't it? 45,000 will be there. Right? Because it is 10 lakh 50,000. So on the 2.5 lakh, it is 10%. So 25,000 plus 20,000. So here, this will be 45,000. 25K plus 20K. So what will be my rebate? Rebate is 45,000. So I will be paying no tax effectively. Are we clear? Now what if my total income is greater than 12 lakh? Then if my total income is exceeding 12 lakh, then I have to follow 3 steps. My step number first is total income minus rupees 12 lakh. My step B is compute the tax liability on the total income. And my step C is, or step 3 is, if my step B is greater than step A, right? Then my rebate will be B minus A. So, if I have to read that again, right? Let me copy that over here so that you are able to appreciate and understand. See, yes. The total income exceeds 12 lakh rupees. Right? The total income exceeds 12 lakh rupees. This is what I have written over here. So this first wording is saying if the total income is exceeding rupees 12 lakh and the income tax payable on such total income, which is nothing but my step B, exceeds the amount by which the total income is in excess of 12 lakh rupees. So it is saying if B is greater than A. So this is talking about this is first part. This is my step B. Right? This step B is exceeding the step A. Right? This is my step A. The amount by which the total income by which it is more than 12 lakh. So total income minus 12 lakh. An amount equal to the, so if B is greater than A, an amount equal to the amount by which the income tax payable on such total income, which is nothing but my step B. This is nothing but the step B, right? Is in excess of the amount by which the total income exceeds rupees 12 lakh. This is step A. Right? So B minus A will be allowed to me as a rebate. Are we getting this particular point? So if I have to put it simply, this is how you will calculate if your total income is exceeding 12 lakh rupees. So this is going to be allowed as the deduction. Now the deduction which is allowed under 156, right? If you go back further, what does it say? Hello? Yeah. 156.3 now again says the deduction under subsection 2, right, which is in case of the default tax regime, shall not exceed income tax payable as per the rates provided in 2021. So your rebate cannot be more than the tax payable as per the default tax regime. Which means what? Which essentially means what? That you cannot get a rebate on the income which are taxed at the special rate. For example, LTCG, STCG, these are taxed at special rate. These are not taxed in 202. So you cannot claim a rebate on that. Okay? So the rebate cannot be greater than the tax under 202, which implies rebate is not available on the income taxed at special rates, example LTCG or STCGs, right? Are we clear? Right? Let us look at an example for this. Let us say, for example, for this, there is a resident individual has the total income of rupees, let us say 12 lakh 15,000. Okay. So in this particular case, first of all, we'll calculate the tax. Let's say he goes as per 202 only, doesn't opt out. So it will be how much? It is 12 lakh 15,000. So let us go back to the slabs. So it will be, yes, how much will be the tax liability? 20,000 for this, right? 40,000 under this, which is 60,000. And you will have how much? 15%. Right? It is 12 lakh 15,000. Sorry, 10%. Right? So it will be 62,250. 15%. So 2250 plus 60,000. 62,250 will be my tax liability. So my tax will be 62,250, which is 2250 plus 60,000. Now here this is 12 lakh 15,000. So basically my total income is more than 12 lakh. So if I have to talk about the rebate over here under 156, my total income is greater than rupees 12 lakh. So what is my step A? Total income minus 12 lakh. It is 15,000. What is my tax? Step B? Step B is tax on the total income. What is my tax on total income? 62,250. So what I have to do? Rebate is equal to B minus A, which is equal to what? 47,250. Right? So I will get this rebate and my tax will be 15,000. On this, I will add a cess of 4%, which is 600, and this comes to 15,600. Are we clear? Now coming to the old tax regime. We saw that for the old tax regime, the rebate is very, very simple. What is the rebate? Again, only resident individual is entitled for that, but it is 100% of the income tax or rupees 12,500, whichever is lower. But the condition here is that my total income should be less than rupees 5 lakh. If my total income is more than 5 lakh, then I will not be able to get the rebate. Are we clear? And here also you will not get rebate against LTCG or STCG. Okay. So no rebate on LTCG or STCG under 196. LTCG under 197. Because if you look at these sections which are there, 196, 197 which are there, these specifically say that the rebate shall not be given. Right? So 197, 196, you will not get any rebate. Are we clear? Okay. Any questions, any doubt, we can discuss once we open the queries link. Fine. So in the old tax regime, your total income should not be more than that. Okay. So this is very, very simple. Right? So let's take a break over here and then we move after the break to the other entities for the tax rate. Please start the break. Sanket ji. Sanket ji. Break start. let us start back with the rest of the tax rates. Tax rates for the partnership firm. Okay. So now that we have seen for the individual, we are going to look at for the tax rate of the partnership firm. What is a partnership firm? A partnership firm is incorporated as per the partnership law, right? It also includes a limited liability partnership. Now, both of these, LLP, the partnership firm, is recognized as a separate entity. Okay. So it is a separate entity and therefore it will be taxed on its own profits. Yes or no? So what is the tax rate for the partnership firm? It is straight flat 30%. For the partnership firm, the tax rate is directly 30%. Let us write down. There is also surcharge similarly for the partnership firm. So if the total income of the partnership firm exceeds 1 crore, then it is directly 12%. And in case there is income chargeable under the special rates like LTCG, STCG, then that will be separately charged under those sections. So any special rate income taxed at special rates. Fine. Then you also have the education cess and marginal relief also. So similar to the individuals, if the firm's income also exceeds 1 crore by a marginal amount, then in the same way we calculated for the individual, the same way marginal relief will be calculated, which is WN is equal to UN plus VN. Fine. Next is the cooperative society. So what are the tax rates for the cooperative society? Again, here there are two tax rates for the cooperative society. The first is the normal tax rates which are there. Right? The normal tax rates for the cooperative society. So, what are the normal tax rates? Where the total income is less than 10,000, the tax rate is 10%. Where the total income is more than 10,000 but less than 20,000, less than equal to 20,000, it is 20%. And where the total income is more than 20,000, it will be 30%. These are the normal tax rate, right? And plus there is a surcharge. What is the surcharge? The surcharge will be if the total income is greater than rupees 1 crore but less than rupees 10 crore, it shall be 7%. And in case the total income exceeds 10 crore, it shall be 12%. Are we clear? Here also you have the marginal relief. If the total income exceeds by marginal amount, then here you will calculate on the basis that if it would have increased marginally by 1 crore or if it would have marginally increased by 10 crore. Are we clear? And then you obviously have the cess. Now, apart from that, the cooperative society can also opt for the optional concessional tax regimes. The optional concessional tax regime, either under 203 or 204 section. Okay, so what is section 203? So a cooperative society which is resident in India can opt for a 22% tax rate. But it has to fulfill certain conditions, like it cannot claim certain deductions and exemptions. Secondly, a manufacturing cooperative society. A manufacturing cooperative society which is resident in India, which is set up or registered after 1st April 2023. And which commences the manufacturing of article before 31st March 2024. So this was a very limited window which was offered. Then they could have opted for a concessional tax regime which is 15%. So this was a very limited window. If they had commenced the manufacturing before 31st March 2024, only then they could opt for 15%. If they are commencing after 31st March 2024, then in that particular case, they will not be able to claim the concessional tax regime. So basically, this regime would have been exercised by somebody under the old Income Tax Act only. It is not possible now under the new Income Tax Act, because obviously new Income Tax Act is coming with effect from 1st April 2026. But if you have opted under the old Income Tax Act, under the erstwhile 115 BAE section, you can be allowed to claim even now, subject to that you are still fulfilling the conditions that are given over there. You have to still abide by those conditions. In case you fail to violate the condition, you remember 536 said what? It will be deemed to be considered as the income of the current Income Tax Act. Are we clear? And any special rates for capital gains would be applicable at those rates only. Are we clear, students? Any questions, any doubt? Yes? Now, in this case, the surcharge will be for the concessional tax regime. The surcharge is not dependent on the slab of the total income. It is directly flat 10%. Okay? And since there is no threshold limit for applicability of surcharge over here, like it is not like that if it is exceeding 1 crore, it will be 10. It is exceeding 10 crore, it will be 12. It is not like that. So therefore, there is no marginal relief required. Marginal relief is required in cases where your income exceeds a particular threshold and therefore your tax rate changes. Are we clear? Lastly, about the domestic company. So again, for the domestic company, there are 4 kinds of tax rates which are there. Number 1, the general tax rate of 30%, right? Then for the smaller companies, the tax rate is 25%, but the turnover for the tax year 24-25 should be less than equal to the 400 crores. Okay, then they have the concessional optional tax regime. They have the concessional optional tax regime. Okay. So what are the optional tax regime? One is %22. Subject to fulfillment of certain conditions that it should not be claiming certain exemptions or deductions. Next is for a manufacturing domestic company which is set up after 1st April 2019 and it has commenced the manufacturing before 31st March 2024. Just like your cooperative society. Right? It is very similar to the cooperative society regime only. Like 204 only. Right? So, if it has commenced the manufacturing before 31st March 2024, then it is 15%. And any special rate income will be continued to be taxed at the special rate only. Are we clear? So here again, for a manufacturing domestic company, if we talk about, that would have been only under the old act. So somebody would have opted under 115 BAB of the old act. You will still be eligible to claim under the new act also, only on subject of fulfillment of conditions. What are the conditions that you will learn in the assessment of various entities class? Okay, so this is section 200 and 201. Okay. Then what are the rate of surcharge for the normal company? The surcharge would be if my total income greater than 1 crore, less than 10 crore, it will be 7%. And if it is more than 10 crore, it will be 12%, just like the cooperative society. So here you have the marginal relief also applicable. And then you will be adding the education cess. But for companies opting for the companies opting for the concessional tax regime, the surcharge, just like in the case of the basically cooperative society, it will be flat 10%. There is no threshold, so therefore there will not be any marginal relief. Okay, then about the foreign company. Now for foreign company, it is flat 35% tax rate. And if there is any special income tax at special rate, that will be taxed at the special rate only. For surcharge, if the total income is exceeding 1 crore but less than equal to rupees 10 crore, this will be at the rate of 2%. And if my total income is greater than 10 crore, it will be 5%. Are we clear? So here also you will have the marginal relief applicable. Now one more thing that we are going to discuss here is that what is the meaning of this domestic company and foreign company? So a domestic company which is there, it is defined under the Income Tax Act. And you will also learn more about this in the assessment of the various entities class. All of this you are going to reflect over there again. So, when we talk about the domestic company as such, right, the domestic company is basically not equal to a resident company in India. It is also not equal to just by saying that it is an Indian company. Yes, every Indian company is a domestic company. Right? Every Indian company is definitely a domestic company. But there can also be the foreign companies which can also be the domestic company. So when we talk about the domestic company, right? The domestic company is defined under section 242. Or let me, make a table for you so that, you're able to relate it or revise it very clearly. There are different types of company. One is the Indian company, right? Or a company itself is defined under section 228 of the Income Tax Act. So, what does a company mean under 228 of the Income Tax Act? Section 228 of the Income Tax Act defines a company to mean an Indian company or any body corporate incorporated under the laws of a country outside India. So, a company can be an Indian company or any body corporate incorporated outside India. Means a foreign company. Right? Any body corporate. It can be even if a partnership is incorporated outside India and it is treated like a body corporate. There are kind of partnerships in the world which are treated like a body corporate. For example, limited liability partnership. It is a body corporate. Isn't it? Under the Indian law, when we talk about the partnership, it is different. A partnership firm is defined under the Indian law as per the Indian Partnership Act and includes the LLP. So a firm includes the LLP under the Indian law. But under foreign law, a partnership is treated like a body corporate. So that for the purposes of income tax in India, a foreign partnership can be regarded as a company. So it means, first of all, a company means an Indian company or a body corporate outside India. Again, Indian company is defined under 253, which means a company formed and registered as per the Companies Act. Then you have a domestic company. So you see that Indian company is different from domestic company. A domestic company is separately defined under 242 of the Income Tax Act, which means an Indian company or a domestic company means an Indian company, which we have understood over here, and a company which, or any other company, which can be a foreign company also, which has made the prescribed arrangements for the declaration and payment of dividend out of its income liable to tax in India. So any foreign company which has made the arrangements for declaration of dividends in India, that can be considered as the domestic company. Are we getting this? And then you have a foreign company, which is again defined under the law. A foreign company is defined under 246 to say it is not a domestic company. So any company other than domestic company is a foreign company. Now, why is this distinction essential? See, Indian company is defined for the purpose of understanding a domestic company only. But why is it essential to understand the difference between domestic company and foreign company? Because the tax rate for the domestic and foreign company are different. So, for the purposes of determining the tax rate, for the purpose of determining the tax rate, you have to see whether it is a domestic company or a foreign company. So foreign company can also be a domestic company, but it should have made the arrangement for declaration and payment of dividend out of its Indian income. Then there are certain other category of the companies, which is widely held company and closely held company. So what are widely held and closely held company? A widely held is just a nomenclature that we talk, but the Act does not use this kind of language. So what is the language used in the Act? The Act talks about, in the section 229, a company in which public is substantially interested. A company in which the public is substantially interested. That is, we call it normally in the normal language a widely held company. A company in which the public are substantially interested. So as the name suggests, it will include the following companies. Company which is owned by the government, so a government company. The company which is owned by RBI, or any company in which 40% of the shares are held by either the government or RBI or any other corporation which is owned by a bank. So, if 40% of shares are owned by government, RBI, or the corporation owned by bank. Okay. Then Section 8 company, which is the not-profit organization. Then a mutual benefit finance company, which carries on the business of accepting the deposits from the members and which is considered to be a nidhi or a mutual benefit company. So a nidhi or a mutual benefit company, or a company whose shares carrying not less than 50% of the voting power are held by cooperative society. Then a company which is not a private company, right? And the shares as of whose are listed on the recognized stock exchange. So a listed company essentially. Okay. And lastly, an unlisted company other than private company, which is of whose shares are with voting power is held by either government or another listed company. Are we clear? So, a subsidiary of a listed company is considered as the widely held company. Are we clear? And this 50% is considered as 40% in case of an Indian company in ship construction business or manufacturing or mining or generation or distribution of electricity. Are we clear? So, essentially, unlisted company other than the private company whose shares with voting power greater than 40% held by government or another listed company. And this is for company should be engaged in business of what should be the business? Construction of ships, manufacturing of goods, processing of goods, then mining, generation or distribution of electricity. Fine. And what is then closely held company? Basically, closely held company will be other than widely held company. So principally a private company or unlisted company, not regarded as widely held company. So closely held company is a company in which public is not substantially interested. Are we clear? Now, why is this distinction of a widely held and closely held important? So there are certain provisions, some anti-avoidance regulation, some anti-tax avoidance regulation, which are only applicable to a closely held company. Why? Because these companies have the ability to manipulate the profits, have the ability to manipulate the income within their group itself or within the shareholders itself, because these are not held by public, and therefore certain anti-abuse rules are only applicable to a closely held company. And then finally, you have a resident and a non-resident company. A resident company is an Indian company, a foreign company having
Now connected to HoneyBook for PC.
place of effective management in India. And a non-resident company is a company, a foreign company, not resident in India. Now, why this is important? Distinction between a resident and non-resident company to determine the residential status and to therefore decide the scope of total income. Right? So, depending on the residential status of company, you will be able to decide whether its global income is taxable in India, if it is a resident of India, or only its foreign income is only it is Indian income is taxable in India if it is a non-resident. So a resident company is an Indian company, and it can also be a foreign company, can also be an Indian company, a resident company, provided it has a place of effective management in India. This you are going to learn in the NR taxation class. But I'm just explaining you to explain that this is important to decide my residential status. So a resident company is different from domestic company. It is not going to be the case that a resident company is a domestic company. The distinction between a domestic and foreign company is important for the tax rate. The distinction between a resident and non-resident company is important to decide their residential status and therefore what will be their total income. So essentially, a foreign company which is a resident of India, because it has a place of effective management in India, will still be taxed at 35% because it is a foreign company. So for the foreign company, the tax rate is 35%. So a resident company does not become the domestic company. Are we clear? Okay. So this is about the companies. Okay. Are we clear about this? Now the last part of the chapter is pertaining to the different provisions that we are required to cover, right? So there are certain, concepts which you have to understand as from the perspective of the basic concepts. So understand here that we are here going to tax the total income. We discussed about what is total income, right? Now, we also discussed about the definition of the income, isn't it? Now, one more important thing that we need to understand in respect of the definition of income. As I said, the definition of income is inclusive definition. So means something can also be included even if it is not specifically listed in the definition. Right? So what is my income? So income essentially means a periodic monetary return. Right? A periodic return. So does it mean some sort of casual income will not be treated as income? It will still be income. If you look at the definition of income, it also includes the casual income. For example, winning from lottery. You don't make a business out of winning the lotteries. It is casual income, one of a kind. Crossword puzzle. That will also be considered as my income. So essentially, anything can be income. Right? But not all receipts are going to be income. Not all receipts are going to be my income. So I have to understand that there is a difference between the revenue receipts versus capital receipt. So income normally means the revenue receipts. So revenue receipts are always going to be considered my income. The capital receipts are not going to be considered my income unless the definition of income specifically provides that this is going to be considered as income. Right? So what is capital receipt and what is revenue receipt? So the revenue receipts are basically your routine receipts from the, providing any services, from undertaking any business. This is not something which is defined under the law. Over the time, it has been understood by judiciary in this manner. So if there is a transaction entered into the course of a business, the profits which are arising from my business that I am regularly carrying out, incidental to my business, associated with my business, are going to be my revenue receipts. Right? So that is my revenue receipt. Then what is the capital receipt? Capital receipts which are there are essentially going to be one of a kind income, right? Which are capital in nature. For example, capital gains. It is a capital receipt, right? So if let's say for example, I have earned income from the sale of asset, it is a capital receipt. Ideally, it should not be taxable. But because the definition of income specifically provides for taxing the capital gain, it is considered as my income. Right? So there is no clear test of regarding whether this is a capital receipt or revenue receipt. Courts, judiciary over the time have considered, what is capital, what is revenue. So profits from sale of asset is capital receipt. Profits from sale of a trading asset, a stock in trade, is my revenue receipt. It is a business income. Isn't it? Profit arising from the sale of shares in security. Now again, it is a very thin line. If I am a trader by nature, if trading in shares is my day-to-day business, then it is the revenue receipt. But if I am carrying the shares as investment with the motive of making the long-term investments, earning the return from that, and even then if I am selling it, it will be capital gain. So the CBDT in its circular has given lot of tests to decide whether this is revenue receipt, whether it should be taxable as PGBP or it should be taxable as capital gain. See, your head of income will also change. Right? So that again you're going to learn in the capital gain class. So if you see, if you are doing the speculative transaction intraday, it is regarded as speculative business. FNO is regarded as business income. Right? If you are doing it for the longer term purpose, it is capital gain. Even short term can be capital gain. But the intention should be to not do the day-to-day operations. But if you see, for example, for the foreign institutional investor, even if they are doing the business of trading in shares, they just purchase and sell the shares on day-to-day basis. But still, the act specifically says that the stocks held by the foreign institutional investors will be regarded as a capital asset, even if they are doing the trading. Are we clear? So, whether a transaction is a business or whether it is a capital receipt, that is something you will have to see how the day-to-day operations are carried out. Right? What is the conduct of the assessee? What is the nature of the transaction? How many is, or what is the quantification of the transaction? Right? What is the daily, target or the daily kind of transactions taking place? Based on that, you will decide. Now, for example, if we talk about gifts, gifts are capital receipt. But income definition specifically covers the gift. You don't receive gift daily. So income definition specifically says receipt of property without consideration shall be considered as income. Now there is one more case law in your module, which is on the receipt of liquidated damages. So let's say, for example, if you supplied the plant and machinery, if you are a supplier of the plant and machinery, right? And you supplied the plant and machinery little late to the buyer of that plant and machinery. Now, because of which the buyer suffered the losses. So the buyer is asking for the damages from the said supplier. Those are called as liquidated damages. So if the buyer receives these liquidated damages from the supplier of the plant for failure to supply the machinery within the stipulated time, whether it is a capital or a revenue receipt. So the Supreme Court in the case of Saurashtra Cement Limited had held that these damages are linked with the procurement of a capital asset. Because the plant and machinery was delayed, this compensation was received because the buyer suffered the loss because of the delay. So these damages are linked to the capital asset. This is linked to the impact on the profit making asset, profit making apparatus. So because of the impact on the creation or the existence of the profit making asset, which was going to come into existence, or the profit making apparatus, this is not a receipt in the course of profit earning process. And therefore, this will be a capital receipt. Then where, let's say for example, if you terminate the contract of any person, any agent, any company, and you have to compensate them, you have to give some compensation for termination, it is a capital receipt. However, the definition of income specifically considers such sort of compensation as the income. If your employer gives you the terminates your contract and give you the compensation, it is again a capital receipt. But the Act specifically in the definition of income provides that this is the income. So capital receipt will not be chargeable to tax unless and until it is specifically considered in the definition of income. Similarly, with respect to the revenue also, expenses also, you have to categorize whether it is a revenue expense or capital expense. If it is a revenue expense, it will be deductible automatically. A capital expense will not be deductible unless the Act specifically provides for its deduction. For example, cost of acquisition of a capital asset, Act specifically provides. You will see in the chapter of PGBP, there are many capital expenses in respect of specified businesses which are allowed as the deduction because the Act specifically provides for that. There's another Supreme Court ruling which is given in your module, which is with respect to the interest paid by the bank for broken period on the purchase of securities. So usually in the case of bank, they are required to invest their amount in the government security. Now, when you purchase the government security, understand this very carefully. You purchase it, let's say, mid of the month. And let's say the interest becomes accrued on the 1st of the month. So the seller was holding, let's say from 1st April to 15th of April. The buyer is purchasing on 16th of April. Now when the buyer purchases for the 16th of April, what will happen? On the next 1st of May, the buyer will get the interest for the entire month. But is he entitled to it? No. The seller should be given the interest for the 15 days because he was holding it for the first 15 days. So the buyer, when he purchases the security, he is required not only to pay the price of security, but the upcoming interest for those 15 days. That is called as the broken period interest. Now the question is, when the buyer pays this, will he be given the deduction of this? The Supreme Court in the case of Bank of Rajasthan observed that if the bank is holding the securities which it has purchased as held to maturity, right? So held to maturity which are there or available for sale. So bank has to, categorize its security into three segments: held to maturity, available for sale, and held for trading. So as regards the available for sale and held for trading, the securities are considered as stock in trade. So if it is stock in trade, the deduction of the broken period interest will be given. For the held to maturity, these are long-term investments. So in those cases, it is an investment, it is a capital asset, and therefore the broken period interest will not be allowed as deduction because it is a capital expenditure. Are we clear? So when you're talking about the income, you have to consider the expenses also, because when you talk about the income means net income and not the gross income. The income is always the net income. So therefore, under every head of income, you will go and find out what is allowed as deduction, and then only the net income will be chargeable to tax. Also, income can be taxable on due basis or on the receipt basis, and for that again you have to go back to every head of income to decide at what point your income will be taxable. What will be the timing of the taxability? And finally, there is something called as the concept of diversion of income by overriding title versus the application of income. In the case of the application of income, means you are applying the income, let's say, for any expenses. It's application. I got my salary, I'm purchasing some clothes, that is the application of income. Whereas in case of diversion of income by overriding title, it means that I was supposed to receive my salary. But what I have done, I have asked my employer to divert this income even before it reaches me to my spouse, so that I can avoid the tax liability. That is called as diversion of income at the source by overriding my title with my spouse's title before it even reached to me. And in that particular case, the income will still be considered in my hands. That is what even your clubbing of income says. Are we clear? Okay. So these are all the concepts that you need to keep in mind with respect to the taxability of income. Now, before we end the session, I would like to invite you with, let me just, give you the meeting ID so that you all can join for the queries if you have any. So the meeting ID is, I'm writing it on my screen. Eight six two 3850 0732. 862-3850-0732. You all can join and please ask your doubts if you have any. Eight six two 3850 This is the meeting ID. You can join. And if anybody has doubt, please raise your hand. Yes, Radha. Yes, Radha, you can unmute yourself.
Okay. Am I audible now?
Yes.
Okay. Ma'am, actually, with regards to under rebate section 156, you were explaining subsection 2. I wasn't able to understand its interpretation about the default tax regime under which you were explaining that specific clause, right? You had copy pasted that clause. Yes, that one.
Yeah.
Actually.
Yeah.
So I wasn't able to understand. Can you please explain it?
Sure. See, it says the total income exceeds 12 lakh rupees. This point. Okay.
Yes.
And the income tax payable on such total income. This one. Step B. Income tax payable on such total income, right? Exceeds the amount. So we are writing here this B exceeds the amount by which the total income is in excess of 12 lakh rupees. Total income is in excess of 12 lakh is A, right? So B exceeds A. When B exceeds A, have you followed till here? Yes. Then what is my rebate? An amount equal to, so my rebate is equal to the amount by which the income tax payable on such total income, which is B, right? Income tax payable on the total income is in excess of, which is minus, the amount by which the total income exceeds the 12 lakh. Total income exceeds the 12 lakh is A. So it is essentially B minus A. I hope you have followed it.
Yes, just a minute, ma'am. Okay, I got the point that you're talking about the A is specifically denoting 12 lakh rupees. The second one is
No,
what
no.
is the.
A is total income minus 12 lakh.
Oh,
Total
sorry,
income
sorry.
in excess of 12 lakh.
Oh,
Yes.
sorry, ma'am. Yeah, total income in excess of 12 lakh, and B is a tax on it. And then we
Yes.
need to check the third one as B is greater than A so that we can compute the rebate of the differential amount.
Correct. Yes.
Okay, ma'am. That is fine. Understood that. Ma'am, second one, like query, I would like to just make a request to you for providing a summary table for surcharge with respect to default and old tax regime. That would be much easier, even though the examples were comprehensive.
So it is given in the module, like,
Okay.
once you get the module on the website
Okay.
as hosted, it is given in that, and you will not be then requiring any of the summary because it is well summarized over there.
No issues.
Yeah.
Ma'am, with regards to the cooperative society tax rates which you were explaining now, there was a minor lag where under section 203 you were saying 22%, and then you were explaining something that I missed out because of the lag.
Sure. Sure. So 203 is 22%. 204 is for the manufacturing cooperative society which have been set up after 1st April 23 but which commences the manufacturing before 31st March 24. For them it is 15%. So this essentially means that for 204 the cooperative society would have opted in the old income tax act only because this is obviously commencing the manufacturing before 31st March 24. So it is not possible under the income tax act 2025, right? So if the cooperative society has opted in the income tax act 1961 under the old 115 BAE section, it will also be able to claim this rate in the new income tax act section on the basis of section 536 that we learned yesterday. But subject to it fulfills the conditions which are mentioned over there. If it violates any of the condition, then obviously it will not be able to claim in the new act and then it will be considered as their deemed income.
Ma'am, surprisingly, I just noted that it's only a 1 year difference between, it should be set up after 1/4/23 and just commence before 31st March. What was the logic behind this? Just if they needed to bring for 1 year.
No, so it is only, a limited time offer that they had, kind of done. See, India is not a country which allows the concessional tax rate.
Right.
So it is a very high tax country. So it is like, it wanted to boost the manufacturing in that year, and that's the reason why it gave a one-time offer.
Okay, got it. And
Yeah.
ma'am, with regards to widely held company, which you explained, na, in the
Yeah.
unlisted company part, was it only the voting power exceeding 50% or just
Yes.
50%?
No, exceeding 50%.
Okay. And with regards to one more thing, at last you were explaining with broken period interest,
Yeah.
the securities which were held for trading. I am
Yeah.
confused actually, ma'am, because see, held for trading or available for sale is treated as a capital receipt or only the other than
Held
it.
for maturity. Yep. I'll
Yeah,
explain. So held for maturity is basically, as the name suggests, it is to be held for a longer period of time until it matures. You cannot sell it, right? So that is a capital asset. It is an investment and therefore it will be a capital expenditure. The held for trading, as the name suggests, it is available for trading. You can, sell at any point in time. Available for sale, as the name suggests, again, you can sell at any point in time. So those are considered as stock in trade and the expenditure will be the revenue expenditure.
correct. And just, ma'am, another one which I wanted to know with regards to the speculative business which you were talking about, like what is their classification? I wasn't getting it.
Yeah. So FNO, for example, is treated as business income. Intraday trading is regarded as speculative income. You're going to learn more in detail in the PGBP class about it. Like, what is exactly the speculative income. So intraday kind of trading is a speculative income.
Got it. Intraday is part of business income, and intra the same day trading is other than
No, no,
business.
no.
Okay.
No, no, no.
Okay,
So
okay.
F&O, like your derivatives,
Yes.
commodity derivatives, right?
Mm.
Futures options, those are the business income, normal business income.
Okay.
Intraday is where basically you do not take the delivery of the stock.
Right.
Like I sell, I buy. I buy, I sell same day. Like there's no T plus two. Right? So where I don't take the delivery, that is considered as my speculative income. Like, I'm just rigging the stocks. So that is my speculative income. And that is also business income, but considered as a separate because the losses of speculative business are not allowed to be set off against the normal business.
Correct. Yes, ma'am. I got that. And the final one, with regards to foreign company and domestic company, you were explaining that all the domestic companies are Indian, not an Indian company, but all Indian companies are domestic company. And with regards to the foreign company also, they can be an Indian company. But now,
Yes.
what is the implications of the tax on it? That was unclear to me.
Sure. So as I said, domestic companies will be taxed at, whatever 30, 25, 15, 22, whatever tax rates are there. Foreign company, even if it becomes a resident of India, it will still be taxed at 35% because it is a foreign company. A foreign company doesn't become a domestic company. Even though it may become a resident company because it has a poem in India, but it doesn't become a domestic company. So a foreign company will be taxed always at 35%.
Okay, so a foreign will always be a foreigner, not a
Yes.
part of
Yes.
domestic one. Okay,
Yes.
clear, ma'am. Yes.
Sure. Anybody else? Any questions? Yes, anybody else has any question? Please raise your hand. No questions? See, I would just, request you one thing. This basic concept, see, it may not be that important, but this sets your foundation for the upcoming lectures. Number one. Number two, in terms of the kind of questions on the basic concept, there will not be any questions on the basic concept directly. You will have the full-fledged question where you will be asked to determine the tax rate. You may have certain questions, full-fledged question where you will have to, decide that whether it is a capital receipt, so you will not tax it, whether it is a revenue receipt, whether it's a capital expenditure, therefore not allowed as deduction. So that particular thing will be useful in your entire question, right? And number three thing is that in terms of the Income Tax Act 2025, as I said, that you will have to keep referring to the bare act as much as possible because that will help you understand that how the language is worded. For example, you may just not rely on the summary. So if you look at it, like we saw about 156 rebate, we read the provision, we tried to dissect it and then understood what it is saying. So that will help you to interpret the law very clearly. Yes, Radha, you have question?
Yes, ma'am. Actually, with regards to previous class, I did some certain reading. You were explaining with regards to principle of agisdem generis and nociture sources. So I was a bit confused about it because both are related to the ambiguous interpretation, right? So can you just tell me the distinct line of difference of how to, classify it?
Sure. So, adjustum generis is essentially, let's say, for example, if, let me give you an example through the act itself. Let me just open the act. So I'll be better able to explain you.
Sure, ma'am.
So let us say, sorry. One second. Let me see where is the intangible asset definition given. Okay, let me go to the old act. It is much easier for us also. So erstwhile section 32, which was there. Let's see, yeah. It talks about in respect of depreciation. Obviously, the new act also talks about in a similar way. It says know-how, patents, copyrights, trademarks, licenses, franchisee, or any other business or commercial rights of similar nature. Now, while interpreting this term, now act does not clearly mention to me that what do I understand by business, other business or commercial rights, right? It is not very clear. Now, even if I apply a literal interpretation to it, a strict interpretation to it, are you able to get anything out of it? The answer is no. So therefore, I'm applying the second principle, which is, let's say, purposive. Again, I'm not able to come out with anything. Like I may look at, the memorandum, it also says the same thing. So I'm applying this principle of adjustum generis. To understand the meaning of this term, I am understanding what does these mean. So these are intangibles. So this any other business or commercial rights of similar nature will also be something in the nature of intangible. For example, licenses. For example, rights of tenancy. Any other transferable rights. Right? So that is what how you apply the principle of adjustum generis.
Okay.
Right?
Yeah.
Yes.
Last time, actually, you also quoted about goodwills. But
Yeah, here only. Like, for example, here they have then specifically said not being goodwill of a business or profession. So they have removed it. But that will include the goodwill. Because it includes the goodwill, they have specifically excluded over here.
that means we need to just associate it whatever in the specific
Yes.
class. So
Yes, the
that
class of asset. It is referring to the similar class of asset.
similar
Now,
class.
another for nocitor assets, let me go to section 9. For example, here it talks about the fees for technical services. It is defined over here. See, fees for technical services means any consideration for rendering of any managerial, technical, or consultancy services. Okay. Now there were disputes as to whether technical will include, payment of any, software, payment for, let's say buying a chat GPT, whether that is technical. So the Supreme Court referred to this principle of nocitor assesses to say that this technical will derive its color from the neighboring words, which is managerial and consultancy. Since managerial requires a human intervention, consultancy requires a human intervention. So technical cannot be any automated services. It also has to require the human intervention.
So what can be the term? Because for agisdom it was a same class, but for here,
Yes.
what?
The
How can
neighboring
we?
term, the color of the neighboring words. If it is lying something in between, I will look at the neighboring term. I'm not looking at the class over here. I'm looking at what is the interpretation of the neighboring words. Basis that I'm trying to interpret this term.
This is a very crazy thing because we are
Yeah.
filtering out in a very human base. Like I think this was the case study of Bharti et al. I don't remember that.
Yes, Bharti et al. Yes.
Yeah, yes. So that's what I referred and just wanted to. Ma'am, this all questions will come in exam or it's just to interpret the
No.
law?
It's just to see, you have to develop the understanding now that you are in CA final. This
Right.
will be very useful in your practical life. So obviously, this is not going to be asked in the examination, but this is more from a practical perspective.
Wonderful, ma'am. I'm very like I never expected that in the first two classes itself we will be having such a huge knowledge base, actually.
Thank you. Yeah.
Yeah. So yes, I understood overall gist, but I think I will need to rewatch your lecture again, ma'am, because I'm not able to grasp it in a very faster fine tuning with it, ma'am. I don't know why. Can you
Yeah.
just guide me? How can I just grasp
See,
it? Because yeah,
what you can do is number one, obviously the your direct tax will get more heavier with the
yes,
other lecture. This is
yes.
just the first lecture. So you will have to read the module before you attend it. So try as much as reading because that will you will be able to correlate much better if you would have been read well. And then after the lecture also you should again revisit it to compare. Then it will be like much more clearer for you.
But unfortunately, we are not having modules, so I
Yeah,
think
it will be released in a it's just matter of time. I think where in few
correct.
weeks of time you will get everything. So definitely, yeah, once it is out, and I will also request it so as to publish it as early as they can.
So I can like I have one idea, ma'am. By that time, like, can you tell in the next class what all things like basically what are you going to teach? So I will refer it from the barrack itself.
Next will be the PGBP.
Okay. Oh, like part till what section are you expecting to cover? Like till that I can
Uh,
reference.
it will be the basic first section itself, like the charging section of the PGBP, because that itself will take a longer time to understand.
No issues. So I will be
Yeah.
before and be ready. Okay.
Yes.
Thank you, ma'am. Thank you for
Thank
being
you.
so, graceful and making us explain in a
Thank you
very
so
good way.
much.
Yeah, ma'am. Thank you.
Anybody else has any question? Yes. So if there are no questions, I think we can close the session. Sanket ji, we can close the session. Thank you.